Yeah, good day, class. I welcome you again to our third, 40 term revision. We are just pushing on to our November examination. I'm sure that we are really revising and engaging. Thank you very much for connecting to Metric Hub. This is a provincial examination assessment, which is actually a November paper. It is November grade 10 economics paper 2. So on this paper, what I just wanted you to know is that this is basically a scope and the revision checklist in terms of paper 2. When you're going to do your paper 2, just note that you can be able to check your comprehensiveness in revision through this presentation here. So without wasting any time, let's go into our paper. I'm sure that I always tell you that when you are writing exams, always read instructions. Ne? Instructions are very important, which is that section A is compulsory. Section B, you answer any two questions of the three questions that are given. And then section C, you answer one of the two questions that are there. So this is very important. And then obviously any other instructions are very important. You answer only the required number of questions and so forth and so forth. So now we want to look at section A. It is highlighted that is compulsory. So we give the best choice of the option that are given there. So a market structure where the nature of the product is unique with no close substitutes is known as dash. I'm sure that you remember market structures. The four below are market structures, which we are saying that there is one where the nature of the product is unique. When it is unique, it means it is what? It is different. It's totally different. It is different, and then there is no close substitutes. These are products that can be used in place of it. We are saying products that can be used, products to be used in place of one another, to be used in place of what we are having is called a substitute. So when we look into that, uh, this is actually a type of a market structure where we have no close substitutes. It is actually a monopoly. Monopolization or a monopoly. When we say monopolization, it is the influence which monopoly have on market control, whereby there is actually uh, one product which is keenly produced or supplied by a certain supplier, and then the supplier is full control of the market. The supplier actually controls what happens in the market. It is because he is the only supplier, is only the one producer, one provider of such a product. So now what you need to know is that that is called a monopoly market structure. It is called a monopoly market structure because of that reason. No close substitutes are there, and then also the product is unique. As such, the supplier has got a full control of the market, and then the amount of money or goods or services that a person is willing to exchange for a particular good or service, the amount of money that or goods we are talking about trade in this case, that a person is willing to exchange is willing to exchange for a particular good or service. It is known as what? It is known as we are saying economic value. It is not economic value. Economic value, we are not looking at amount of money or goods that a person is willing to exchange. When we're talking about exchange, it is actually the understanding which is there based on the exchange of value or the exchange value that the person is having to say, in place of having this, what is it that the person can, how much money is the person willing to exchange for a particular good? So there is equating, there is weighing of value in terms of the transaction that is to be done. So it is called exchange value. Utility derived from the additional unit of a good of a given good that were consumed by the consumer is known as dash utility. So now what we are saying is that when we look at additional unit is where the point is coming from. That additional unit of a given good that were consumed by the consumer, we are saying additional unit. When you look into that, we identify that as what a marginal. We say marginal cost, marginal unity, marginal what. So we are saying this is a marginal. It is a marginal utility. So we are saying it's called marginal as we look at an additional unity that of a given good that were consumed by the consumer known as, is known as marginal utility. Average is when we look at the total divided by what? By the number of units that are there. And then obviously when we say unit is just one, when we look at total, it means all of them, inclusive all of the items that are in present. So it's called marginal utility. Tax that is paid indirectly by consumers through the purchase of goods and services is known as dash. Consumers pay through the purchase of goods and services, which is known as what? It is indirectly by consumers. It is called as what? It is known as we are saying direct cost, but I mean direct tax. It can't be direct because we already said that it is paid indirectly. And then we can not say progressive tax income. This is for people when we talk about the money when they earn. When people earn, they earn through we have got a taxing system called the progressive income tax. And then indirect tax is when consumers pay an amount of money for purchasing of goods and services, which we are saying it's an indirect cost. It's an indirect tax, so it is called indirect tax. A curve that shows the combination of any two goods. So it is a curve, a combination of any two goods or services that can be attained if all the available resources are fully utilized. We are saying when all the available resources are fully used, are fully used and fully and efficiently used, it is known as dash curve. Uh, when we look at the combination of two goods or services that can be attained, that can be produced, that can be produced, that is being attained, that can be produced if all available resources are all the available resources are used and are fully and efficiently used. We call that production possibility. I'm sure you remember this to say when you look into your uh, content, you identify that production possibility. It identifies all this as to say that it's a curve that shows a combination of any two goods or a service that can be produced when certain available resources are used efficiently. So we call that production possibility curve, which shows the inefficiency and efficiency of producing a certain good or a certain product. So a market, a market where physical and mental efforts are used in the production of goods. So we are saying physical and mental. This identifies, I think it has to look at human. When we talk about physical and mental the mental, it is about people used in the production of goods production of goods is traded is known as product market. Not exactly, we are saying when we look into this, it is actually a labor market. It talks about the personal, human resources. Human resources, where do we find them? We find human resources in the labor market. We talk about personal resources. This is about people, which we are saying is what is found in the labor market. An increase in the productive capacity of the economy over time is known as dash. The increase in the productive capacity of the economy over time, it is known as, it is actually known as what? Production capacity of the economy over time when it increases. So we need to understand that this has to do with uh, the increase in production in productive capacity. It has to do with economic growth. Economic growth. If you refer in our I mean from the channel again, we have talked about economic development and economic growth. There is a time where I distinguish these two. So for reference, just go look at that. You will find out that these are totally some basic uh, concepts that need to be understood when we are in economics. The movement of people from one country to another to benefit from the greater economic opportunities in the receiving country is known as when people move from one place to another, one country to another country. We are talking about South Africa. People are moving from South Africa to Germany. As an example, we are saying people are moving from South Africa, they are moving from South Africa to India. People are moving from India to United States of America. So now what we are saying is that movement of people to benefit from the economic opportunities. That is to say, there is wealth, there is better living conditions in that receiving country. We define that as what? As migration. It is migration. Globalization is just about trading, doing business across the globe amongst the various countries that can interconnect irrespective of where they are, as long as they are able to access and also then be accessed through e-commerce and so forth. Urbanization is something else which defines an increase in economic activities in terms of population, in terms of infrastructure and so forth within a place. Population, obviously, the number of people who are found or a number of organisms within a given place. So that is it. So we need to understand that migration is the movement of people from one place to another, which can be one country to another country. So we have got a perfect market, which we are supposed to match from column B that matches an item in column A. Column B matches an item in column A. So now what we are saying is that column B matches an item in column A. So we are given question number 1.2.1, a perfect market. How to, or what is it that defines a perfect market? A perfect market, it must be a market structure which has a large number of buyers and sellers who are not able to influence the price. It's an ideal, it's the best, it's a real market. So we shall saying a large it is with large number of buyers and sellers who are not able to influence the price because consumer preferences and demand defines that. So it's supposed to be on the option that we are given. It is supposed to mean that we are looking at what? At C. C identifies a perfect market and then complementary goods. Complementary goods. So what I've been saying is that you should be able to define these terms, and then you just look from the option column B, the answer that matches that. So a complementary goods, they are goods that can be used together, or we can say that they can be combined together to satisfy something, to satisfy a need. So when goods are to be used together in order to satisfy a need or to satisfy uh, consumer needs, what we call that? We call that complementary goods. So we are saying the answer is what? It is A. Is A, which is actually complementary goods. And then opportunity cost. Please refer again. It has been explained severally. What is opportunity cost? So the cost of foregoing the next best option is what we call opportunity cost. So when we look at opportunity cost, you should be able to understand that it is the value of the best next alternative, to say that it has not been taken, it has been given up when making a decision or when making a choice. Opportunity cost occurs when there is more than one way or one means of doing things that is there. So a choice has to be made amongst the available options. So the best option is taken. So our opportunity cost is therefore, we are saying it is now the value of the next best alternative, which has been forgone, which has not been taken. So what we are losing for not taking that opportunity, that next viable option, is what you call opportunity cost. So that is to say that the value of goods next to the value of the value of the next best alternative that is given up when a choice is made, which is D, is opportunity cost. Opportunity cost. And then trade union. Trade union, these are organization, or it's an organization that actually exists in order to assist. It's an organization that actually represents the interest of workers. We have got trade unions that are generally there, which works in order to ensure that uh, employee rights and employee remuneration is well taken care of. So a trade union, it needs to be understood that trade union is an organization of workers that promote and protect their interest. It's an organization of workers that promotes and protect their interests of those people. So therefore, it is what it is. It is a trade union. A trade union represents the workers and promotes their interests. Labor rights. Labor rights, we are talking about employee rights. Labor rights, they are basically entitlements. They are basically, they are legal, and then they actually protect employees or workers. So when we look at labor rights from the options that are given here, we must be able to understand that labor rights can be legal and moral entitlements that protect the interests of workers and ensure what they ensure fair treatment in workplace. Labor rights, they are legal and moral entitlements, which is legal and moral entitlements that protect the interests of workers and ensure fair treatment in workplace. So when we are at work, or when we look at an organization, when we look in corporate world, employees have got rights. We have got also some legislative instrument that protects them. But in this respect, what we need to understand is that labor rights, they are quite legal, meaning to say they are well observed, they are very formal, and they are also, as we say, moral, as to say, acceptable entitlements that also protect workers and ensure fair treatment of them. Economically marginalized group. This has been also been explained. What is economically marginalized? Economically marginalized, the word marginalized meaning to say excluded, not inclusive. Economically marginalized, it means these people are actually not included, they are not included, they are not they are not part of a certain affiliation. They are not taken, they are not considered when we look into a society. So we are saying that given these options, economically marginalized group, from the very available options, it can identify that it's a segment of society that faces significant economic challenges and barriers. We are saying a segment, which means a representation of society that faces significant economic challenges and barriers, limiting their access to resources, opportunities, and social mobility. So what we need to understand is that this is economically, we are looking at economically marginalized group. They face serious economic problems and barriers that limit their access to resources. So they are excluded. There is no inclusivity in their in terms of their representation. They are not being taken into account. Otherwise, they need a government intervention for them to be what to be taken or to be put into consideration. So this is what that will be a segment of society that faces significant economic challenges and barriers, limiting their access to resources and opportunities, as well as social mobility is what we call economically marginalized. They don't have access to the wealth of the nation. Unemployment rate, unemployment rate, unemployment rate class, unemployment rate, if you look at this, it actually has to be, when you look at a rate, it must be a percentage. It is a percentage when you look at a rate. The percentage number of people who are not working. We are looking at the percentage number of, it must be also uh, the number, it should include economically active population. Economically active population must be found in the unemployment rate is the number of people, percentage number of people who are economically active, who are not working, and also they are willing to work. So if we look at the options that are given here, we must get the right way, that we must be able to get the best option or the best answer there. So it is a percentage, the percentage of the economically active population that is unemployed uh, is what is what you call unemployment rate. The percentage number of the economically active population that is unemployed within a specific area or demographic group. Demographic, we are looking at the population representation, population population representation, which is normally we look at a certain age group within a population structure or a population pyramid. We identify the demographics as to say the variation in terms of the representation of people within a given country or in a given country and so forth. And then full employment. So we are saying number Number 7 is age. Unemployment, unemployment rate, it is age, which I'm saying the percentage of the economically active population that is unemployed within a specific area. And then full employment, we are looking at people who are working. It has to look at people who who are working and who are willing to work. So we look at that, they are also supposed to be working. So when we look at full employment, when when all the people who want to work, who are looking for a job are able to get a job, it's full employment, which is G can give that. G G are the when the people who want to work, who are looking for a job, are able to get a job. We explain or describe that as what? As full employment. We define that as full employment. Understand? We define that as full employment. Let's get to the next question. we need to give one term for each of the following descriptions. Write only the term next to the question number. We don't use abbreviations. We don't use abbreviations, class. We don't use acronyms. That is unacceptable. So we must be able to give the terms that define the statement that are given here. The degree of satisfaction that a household, degree of satisfaction that a household or a consumer derives or expects to derive from the consumption of a good or a service. So when we look at that, which is to what extent is a consumer or a household satisfied uh, or is expecting to be satisfied from consumption of a good or a service, we define that as utility. That is called utility. It is called utility. I said that there is we are going to look at other various questions there. Types of utility. There are types of utility that are there. There are types of utility that I want you to look at, which sometimes you might also be asked to say, identify the different types of utility. List any forms of utility. So it can be utility of time, utility of space, utility of form. Any of those can also identify, or there are forms of utility, utility of time, utility of place, and also utility of form. So what I'm saying is that it is the degree of satisfaction a household or a consumer derives or expects to derive from consumption of a good. That's what we call utility. And then a form of financial assistance or benefit that benefit from the government to businesses to promote specific economic activities. When the government gives assistance to businesses in order for them to be able to do better, we call that subsidy. It's called a subsidy. It's a financial benefit, a financial assistance. Subsidy is actually that it defines assistance from government. Government gives empowerment to its citizens for various reasons. In most of the times, it's actually to boost and to stimulate production. So in order for us to stimulate production, government gives support, which is given in terms of some percentage amount of money that they receive in order for them to produce. Number three, when the market provides goods and services according to the taste and preferences of consumers, according to the taste and preferences of consumers, we call that allocative efficiency. That is called allocative efficiency. Allocative efficiency. When market provides goods and services according to the taste and preferences, according to the interest, what defines what is supplied to the market is what consumer wants. The goods or the preferences of consumers is the motivator of what can be supplied or what can be sold to them at the market. So we call that allocative efficiency, when goods and services are provisioned to according to the taste and preferences of consumers. Number four, an act that regulates the organizational rights of trade unions, promotes and facilitates collective bargaining at workplace. When we look at this is called a legislative instrument also. It's called legislative instrument. We have got COEDA, we have got Basic Conditions of Employment Act, we have got triple BEE, and we have got whatsoever. So what I want you to understand is that when we look at the regulation of organizational rights of trade unions, promoting and facilitating collective bargaining at workplace, it is actually regulated through the Labor Relations Act. The Labor Relations Act works to ensure that labor relations. It looks at the interests of labor. It looks at the interests of human resources. So trade unions participation, it is actually gazetted and made to be legal through the Labor Relations Act, which is a national legislative tool that is used in control and management of human resources in terms of fair treatment at workplace. That fair treatment includes collective bargaining, as to say both parties all participants are involved in terms of the deliberations that need to be done with regards to employee rights or organizational uh, control of employees at workplace. Unemployment caused by a mismatch between the skills the employer requires and the skills that employees offer. When employers have got a specific skill that they want, however, the employees have got the opposite of that. We have talked about types of unemployment. So this is called, it is defined as what? Structural unemployment. Structural unemployment. Structural unemployment. So what happens is that the skills which people has or have are not exactly what is being looked for by the employers. Employers require specific or particular skills. So unfortunately, people do not possess or they do have opposite of what is needed. We explain and define that as structural unemployment. I'm saying look on the videos again on the channel, types of unemployment. You shall see that there is quite a good video or good explanations that defines that. And then the fairness and justice in the distribution of wealth, income, and other economic resources. So this, it looks at, it focuses on ensuring that every citizen or every person is actually benefiting from the wealth of the economy. I mean, from the wealth of the state. So it is that justice that is there. So we define that as economic equity. Economic means wealth, equity means fairness. Economic economic equity, economic equity, it identifies that the fairness and justice in the distribution of wealth, income, and other economic resources. We define that as economic equity. So, class, thank you very much. Let's go to question section B and then answer the following questions. Name any two levels of public. Name any two levels of public sector. Any two levels of public sector. The public sector is it exists at different levels, which can be, we are saying one, we must understand that we can identify it at a national level. I'm sure that you know that we have got the national uh we are saying the labor of public sector, we have got the national, which is at the level of the country as a whole, at the level of the country as a whole, and then at a provincial level, provincial provincial level, which is according to our 9 provinces. According to the provincial level, we are saying according to the level, according to the provinces, we have got different uh, is the hierarchy that we need to understand in terms of public sector representation. And then we also have the local, which can be a municipality. We can say Mangao as a what we are saying Mangao municipality. We have got our Free State as a province, and then we have got South Africa as a whole. So what we are saying is that this is a hierarchical representation in terms of the public sector, discretion of duties, and also participation with regards to different cases and different provisionings that they have to do. And then how does an increase in the price of sugar affect the demand of tea? When sugar increases the price, we are saying this is an example of what? This is an example of complementary goods. They work hand in hand. Not of course we under not unless of course we have got times whereby people who are diabetic or people who naturally don't take sugar, they only make tea by putting tea alone, but they don't put sugar inside. So when the price of sugar increases, how does that affect the demand for tea? So in that case, we need to understand that the demand for tea will decrease as sugar and tea are what are complementary goods. It is actually possible that people will no longer buy or would no longer buy tea because there is no capacity to make tea. So the increase in the price of sugar, it actually uh it actually reduces the demand. It actually decreases the what? It actually decreases the demand. Uh, decrease the demand for tea. It will cause demand. It will cause demand for tea to decrease. We said these are complementary. They are complementary. They are complementary goods. I'm sure that you should understand that the demand for tea actually will go down because people are no longer affording the sugar that they need in order for them to make tea. So now the demand for tea will go down. It will cause the demand for tea to decrease. The demand for tea will decrease. And then we have got dynamics of demand and supply. Dynamics of demand and supply, which is given here. The dynamics of demand and supply. Uh, what is happening here is that the demand, understanding why prices change is one of the most important and fascinating problems in economics. I'm sure we understand that when we are in economics, we need to understand the concepts of demand and supply, how they influence each other. So price changes also affecting the demand of goods and services also. So the law of supply and the law of demand put forward that an increase in supply lowers prices. What happens is that when supply is there or when there is plenty, uh, when supply is plenty, what actually happens is that it actually causes prices to go down because there is variety. People are able to get whatever they want, but short or less of supply results in scarcity. Scarcity as well will eventually cause an increase in demand, which at the end of the day will increase what prices. So while an increase in demand rises prices, obviously we are saying right now iPhone is quite expensive cell phone gadget because it is highly demanded. Almost all, every person want to have an iPhone. So the demand is high, prices goes up, yet the complex inner workings of the mechanism remain partially obscured. So now what we need to understand is that there is an illusion that we need to uncover in this regard. So we want to look in the questions that are coming, identify in the extract above the term that refers to the seller side of the market. So what we are saying is, according to the context that is there, identify in the extract the term that describes the seller's side of the market, the seller side of the market. So when we look in the extract here, what term identify which term we are saying identify the term that actually uh that refers to the seller side of the market, seller side of the market. So there is the consumer side and the seller side. So the seller side is what is supply. The seller has to supply. The seller brings goods to the market. the seller brings goods to the market, and then the consumer demands, the consumer buys, the consumer he is the one who buys the goods that are there. So the seller side of them, the seller side uh, of the market is the what is the supply. The seller has to supply goods to the market. It is the supply. The seller supplies goods to the market. The seller supply. Name one determinant of supply. We're saying is that supply is determined by quite a number of factors. What defines supply? We say that it is demand, it is price, it is also the state of the goods and other complementary goods and so forth. So what we need to understand is that the one determinant of supply, how much do we supply, is affected by, it is affected one by the price of alternative goods and services. Price of alternative goods and services. Goods and I'm sure this you can see it from the first question that we did, that one of coffee and tea, the price of alternative goods and services. I mean, now in terms of complementary goods, but we are saying also alternative as substitute. And then we can also identify as to say supply is also determined by price. Supply is also determinant of supply is the price of goods and services. Price of goods and services, which we can also define as to say demand. Demand defines supply. And then we can also maybe look at we can also look at other factors as to say what defines supply also. It can be, maybe we can say also the availability of technology. Technology also affects supply. Technology also affects supply, which we need to understand that we are looking in a global e-commerce kind of business. So in terms of e-commerce, we need to understand that technology plays a crucial role. If we further explain and interrogate this, we can as well look at the state of infrastructure, which can also be roads and other factors that can also play a role in terms of supply, depending on what is to be supplied. So describe the term demand. Describe the term demand. When we look at demand, we are looking at the amount of goods and services, the amount of goods and services that our buyers are willing to purchase at a given price, also at a given within a given period. So it identifies the quantity, demand, it identifies amount, which we say quantity of goods and services that are possible customers, our customers who are our prospective possible customers are willing. What we say is that they must be willing to buy. They are willing to buy. They are buying at a specific price. At a specific price and particular time. So the demand is confined also to time. There is a change of demand. There is a change in trends of demand over a period of time. So what we need to understand is that there must be a specific price when goods are being, when we are in economics analyzing demand, there must be a price tag that is associated with it. How much is it that we are selling, and how many customers, how much is being wanted to be, or how much is do customers want to purchase at that price. So what we are saying is that that is goods and services that our prospective customers are willing to buy at a specific price and at a particular time. That's what we call demand. Explain the relationship between prices and quantities of goods demanded. Between prices and quantities of goods demanded. This is just something that I just explained now. It's just something that I explained in the beginning, of course, just highlighting you the mechanics of economics with regards to price, I mean to demand and supply. So the relationship between price and the quantities of goods demanded, you should understand that as price of goods as price of goods increases, as prices of goods demanded goes up, which we are saying increases, as it increases, the demand for the goods will go down. The demand for such goods will go down. It will go down, it will decrease. The demand of those goods will go down. So what we need to understand is that as price of goods demanded goes up, the demand for such goods will go down because they are becoming unaffordable. I mean, people are failing to afford them. And then as the prices of the goods demanded decreases, the demand also goes up. So there is what we need to understand is that there is an inverse relationship between demand and price. There is an inverse relationship between demand and price because when price goes up, the demand goes down. So there is an inverse relationship between price and what between price and demand and price of goods. You have an inverse relationship, which is shown here now that in this case, when this prices goes down, demand goes up. That is what we need to understand. When prices goes down, demand increases. When prices goes up, demand decreases. So we have got an inverse relationship. How are prices determined in a market? Price determinants. How are prices determined in a market? Uh, how are prices determined in a market? So what we need to understand is that in order for us to understand, we are saying how are prices determined. Prices are determined mostly by the forces of supply and demand. Prices in a market are determined by forces of supply and demand. So now, what happens is that there must be a market equilibrium that is supposed to be identified, which shows how much is demanded at a given price and how much is suppliers willing to say. So the market forces determines prices in a perfect market, determines prices of goods. So uh, we are saying that is consumer preferences set a certain price for goods, which is again, I said it depends with the type of the market structure. So now we are saying again that there is a market equilibrium that must also be set, which identifies the amount, and market equilibrium is established uh, when the amount demanded is equals to amount supplied. When demand is equals to supply, when demand is equals to supply, we don't have excess. There is no excess in that case. So amount demanded is equals to amount supplied. So that is when we look at this, we can be able to identify and explain all these market mechanics. They will show us all these market forces that we need to look at. So here is the graph that shows that is supposed to be analyzed here. I always say that you always supposed to know that this graph is quite common, and it is supposed to be known by every economics student before going to the exam. So we can talk about it as a production possibility frontier. Production possibility frontier, we can define that as a production possibility curve. Production possibility curve is what we can see here. Production possibility curve. We can also say production possibility frontier. So now we are saying this is the same thing. Production possibility curve, production possibility frontier, which is one and the same thing. It actually analyzes the best possible place or level of production, which we should identify the Pareto efficiency and Pareto inefficient. So now I want us to we want to answer the questions that are coming now. Identify the curve depicted above is what we have already said there. What is the opportunity cost of producing? What is the opportunity cost uh, of producing? What is the opportunity cost of producing 27 units of a service? Uh, If you look at this again, I was saying that we can identify that the opportunity cost of producing, the opportunity cost of produce, what is the opportunity cost of producing 27 units uh, of a service. So we remember we said that opportunity cost, when we say 27, uh, we are saying that we are foregoing how much? How much are we foregoing? So now our opportunity cost, it can be what? It can be 4 units. Remember, we said that when we look at, we said opportunity cost, it is the cost of the next best alternative. So what we need to understand is that given the opportunity, the different options that are there, so when we produce at 27 units of a service, our opportunity cost of the next viable option will be costing us, we are saying it can be an opportunity cost of four units. Briefly describe the term Pareto efficiency. Briefly describe the term Pareto efficiency. Uh, the term Pareto efficiency, I'd say that if you look at this, it is when it is impossible to make one party better off without making another party better off. So we are saying that is when it is impossible, when it is impossible to make one part better off, one part better off without making another part worse off. So another party has to be made worse off in order to make another part better off. So is when it is impossible, it is impossible to make one part better off. It is impossible to make one part better off without making another part worse off. So when we are trying to make the other one better, there is another one that we are sacrificing. So that is what is actually happening in that respect. And then saying, why is point D regarded as Pareto inefficient? Let's look at that. Point D is defined, point D is identified as Pareto inefficient. Pareto inefficient. When we look at that, it actually identifies that at point D class, point D, we are saying that it is Pareto inefficient. What is that? Is that the resources are used inefficiently. There is a wastage of resources in that case. There is a wastage of resources, and therefore there is still room for producing more of a good without, there's still room for producing more there. We still have a capacity to produce more. When we produce here, it's a wastage of resources because we are saying resources are not effectively or efficiently used, and therefore it's a wastage of resources. There is still a room for producing more of a good without a service, with more of a good without, or a service without sacrificing anything. It is possible to produce more of a good without rendering less of a service. So we are producing more of a good without affecting any other services in here when you look at position D. So that is why it is defined as Pareto inefficient. There is a wastage of resources. It identifies a point of inefficient because there is a wastage of resources, because there is a wastage of resources. We can still be able to produce more goods can still be produced more goods can still be produced at point D. If you look at that, more goods can still be produced uh, without or a service without sacrificing anything. Without sacrificing anything. More goods can still be produced without sacrificing anything. So therefore it is Pareto inefficient. What you need to understand again is that it is possible to produce more goods without rendering less of a service. In that position, at D, it is still quite possible. It is still quite possible to produce more goods we can produce more goods without rendering less of a service. That is one thing that you need to understand there. We are still able to produce more goods without affecting or without rendering less of a service there. So let's look at briefly explain how consumers can solve the problem of scarcity. Scarcity is caused because of insatiable. We are saying human needs are too much than the resources that are there. So we can always we always lack because what we want versus what is available for us to get what we want is not equitable. So now, how can we solve scarcity? It can be solved by uh, one, prioritization. We can solve scarcity by one, having a prioritization, prioritize prioritization of interest. We can say of wants. We can say people must prioritize, put a list of what they want. Drawing up a list of what you want, and then you choose the best. We can say that it can also help in terms of solving scarcity. And then we can also have consumers must also draw their limits. Consumers need to draw their limits also. So the prioritization of interest, it is the prioritization of interest. We are talking about priorities which must be put, and then choices be made based on the list. And then differentiate between perfect market and imperfect market. Perfect market and imperfect market. differentiate between a perfect and imperfect market. So a perfect market, when you look at a perfect market, it is a market that consists of large number of firms, whereas the number of we are saying it's a market that consists of a large number of firms or of firms, whereas the number ranges from one monopoly, few oligopoly, and many monopolistic competition. So it is a mix of both. So it is a market. Uh, it consists of a large number of firms, a large number of firms. It consists of a large number of firms ranging from monopoly, ranging from monopoly. You can say we have monopoly. You also have, we are saying it can be monopolies. We can few oligopoly. Few oligopoly. We can also have and many monopolistic competition. Many monopolistic competition. You call that a perfect market. Large number of firms ranging from all the various types of markets. That is it. And then under which we are saying that that is a perfect. And then under a perfect market, firms produce homogeneous products which are identical in terms of quality, under a perfect market. In terms of a perfect market, businesses produce, firms produce what they produce. They actually produce products which are identical. Produce products that are identical. They are identical in terms of the quality, appearance, and packaging. In quality, appearance, and packaging. That is it, and packaging, it all falls in there. And whereas the nature of the products ranges from you, and also the nature of the products and the nature of the product ranges from unique. So those are some of the things that we need also to understand. So now, there is quite a lot of other information that we can add in this respect, which we can talk about. Information is complete under perfect market. It is complete and monopoly, whereas it is incomplete under oligopoly and monopolistic competition. Information is actually complete under perfect market and monopoly, whereas when it is incomplete under oligopoly and monopolistic competition. We also need to understand that entry and exit is completely free under perfect market, whereas it ranges from relatively easy to completely blocked under imperfect market. Under imperfect market, it is relatively easy to completely blocked to what to enter and exit. And then in a perfect market, firms are price takers because the prices are what are determined by the market forces of demand and supply. So market firms are price takers. Like I said in the previous question, that prices are determined by demand and supply. So whereas firms have some degree of control over price, which ranges uh, from little monopolistic competition considerably oligopoly to full control anti-monopoly. That is imperfect markets. Those are imperfect markets. So we also have one other point that I just want to mention, which is firms in perfect markets rely on market forces for decision making. Firms which are under perfect markets, they actually rely on the market forces for decision making, whereas decisions are taken mostly by shareholders and board of directors under imperfect market. Imperfect market decisions are actually uh, they are actually they are made possible by what by the directors. And then last but not least is the issue to do with in the idea that in a short run, perfect competition and monopolistic competition make either economic profit, economic loss, or a normal profit in the what in the long run. Whereas in the monopolistic and oligopolistic oligopoly can make they can make economic profit or economic loss in the short term and makes economic profit in the long run. So basically, these are some of the terms when you discuss this. You are looking at the various approaches or various representations that appears in terms of these types of markets. So you need to look at characteristics that are making these types of market structures. Like I talk about the entry and exit, I talk about the access to information, we talk about the demand curve. For example, that demand curve for an individual seller in a perfect market is horizontal, whereas demand curve for the firms under imperfect market is downward sloping from left to right. That is one other thing. And then collusion does not exist in perfect market. We don't have price fixing. There is no collusion in perfect market. It is only possible under oligopoly in a perfect market. Oligopoly, we have got collusion under imperfect market. So let's have just the last question here is saying, analyze the challenges faced by economists in measuring utility. The challenges that are faced by economists in measuring utility, the challenges that they face. What are these challenges? One, we can talk about interpersonal comparisons. Comparing utility across individuals is challenging due to differing preferences and skills. Interpersonal comparisons, which I want you to understand that comparing utility across individuals is challenging due to differing preferences. Interpersonal comparisons, because comparing preference or comparing utility across individuals is actually challenging due to differing preferences and skills. We also talk about intangible. Number two, intangible, which need to understand that utility is intangible concept, making it hard to measure directly. It is an intangible concept. It's an intangible concept, making it, it therefore it makes it difficult, makes it hard to measure directly. So what we need to understand is that we talked about this utility from the first time, the types or the forms of utility. So it is an intangible concept. It's something that you cannot actually touch, and therefore it is hard to measure directly. And then we also need to understand that there is also the problem of utility versus income, whereby utility may not always increase with income, making it hard to use income as a proxy. Another point that we need to make, utility versus income. I'm saying that on utility versus income, you need to understand that utility may not always increase with income, making it hard to use income as a proxy. So when we want to look at it, we might not use income as what as a reference uh, in terms of assessing utility, because it does not always increase with income. And then diminishing marginal utility again is another problem that we need to look at. Diminishing marginal, we are saying diminishing marginal utility. We need to look at this as to, so the law of diminishing marginal utility makes it difficult to measure utility consistently. I'm sure that you remember the issue of diminishing marginal or diminishing return. So here what we are saying is that to a certain extent it grows up to a certain extent, but when that stage has been reached, it will not continue growing, but it will start giving the negative effect. So it will start decreasing. So now what we are saying is that diminishing marginal utility is one of the main other challenges that economists face, that it actually uh, that marginal utility makes it difficult to measure utility continuously. And then measurement biases, that can also be another point. Measurement biases. Measurement biases. This actually has to understand that we are looking at self-reported data may be subject to biases that are like social desirability or anchoring biases. So what happens is that when data is provisioned or is provided, it is actually, we can identify that self-reported data. It can be subject to biases that are there, the interest of the person who made the data. So it may be social desirability or anchoring biases that can also be associated with such information. And then we can lastly look at data limitations. Data limitations data limitations. In that respect, you need to understand that access to relevant data and quality of existing data can limit the accuracy of utility measurement. Sometimes people don't have the access, don't have the actual data that they need. So what we are saying is that relevant data and quality of existing data can limit the accuracy of utility measurement. How much is that? How far is that data okay or right? So it can also limit measurement. it can actually limit the accuracy of utility of evaluation. So those are the items that we need to look at. Let's quickly go to the question that is next, which can be very interesting again. We want to push it as quick as possible. We once answered this question previously, whereby you need to identify two ways in which unemployment figures name two ways in which unemployment figures are obtained in South Africa, which is one, we talked about the census, to say that when census, the natural counting of people, it can give us to know how many people are employed and not. We can talk about population survey. Population survey can actually be used for measuring, for identification of unemployment figures. We can also talk about Department of Labor. It can also give us registrations of unemployment with the Department of Labor. Registrations of unemployment are saying from Department of Labor. Department of Labor can help us with that. Can also get it from States South Africa. Statistics South Africa can also help us with information which has to do with this. So it can also be sources of data that we can refer to. What is the negative impact of Basic Conditions of Employment Act on businesses? When you look when you talk about Basic Conditions of Employment Act, the Basic Conditions of Employment Act, how does it affect businesses? Actually, we need to understand that it is negative in a way that it actually enforces businesses to comply with many legal requirements, which may increase labor cost or operational cost. Enforces compliance, which may increase operational cost for businesses. Operational expenses, costs. Operational costs for businesses can be increased because it makes businesses to comply. The compliance is quite expensive. And then steel industry unions urged to temper demands in wage negotiations. The strike ended after workers, mainly those affiliated with the National Union of Metal Workers of South Africa, NOMSA, accepted a wage increase of 6% in 2022 and 2023. Workers received increases equivalent to 5%. NOMSA, the biggest trade union in the steel industry, signed the wage deal with the Steel and Engineering Industries Federation of South Africa, which is FISFA, the steel industry's largest employer board, which represents 18 organizations employing about 170,000 workers. So identify the trade union accepted a wage offer of 6% from the extract. We are just looking from the extract there, and then we identify which is given that NOMSA accepted. NOMSA accepted the what? NOMSA accepted the 6%. So the 6% is given there and is accepted by what? By NOMSA. So it is what? It is NOMSA. It is given in the essay there. How many workers are employed by Steel and Engineering Industry Federation of South Africa? We are given that it is actually in the essay which is given that the FISA, it's employing about 170,000. So we have got 170,000, which is given there, and then briefly describe the term collective bargaining. Collective bargaining. When we look at collective bargaining, it is just a process of negotiation between employer and the representatives of employee unit, which is aimed at reaching an agreement about a work-related disagreement. It's a process of negotiation. It's a process of negotiation, which is between an employer and employee representative, between an employer employee representative. It can be employee representative, which is aimed at reaching an agreement, aimed at reaching an agreement of work related problem. That is what we mean by bargaining. Collective bargaining is negotiation between employer and employee representative unity, which is aimed at achieving a consensus of a disagreement of a work-related conflict or work-related problem, and then briefly explain the effects of strike on the economy. When people strike at work, effects of strike actually, they can actually cause loss of production. When people strike, we have got loss of production, which also reduces GDP. Our gross domestic product is reduced. It actually decreases. They can also it can actually reduce economic growth. It can reduce economic growth. It can reduce economic growth. It can also result in, it may cause permanent job losses. It may cause permanent job losses, which can affect people and now shift the responsibility to the government. And then what is the beneficial? Why is it beneficial for the employees to join trade unions? Trade unions, when employees join trade unions, when employees join trade unions, how does it benefit? They actually they protect trade unions. Trade unions they protect employees. They protect employees from job losses, unnecessary job losses. So instead, what they do is they bargain on behalf of employees to avoid job losses that are not supposed to be happening. And then we can also talk about trade unions. They also enable employees, promote fair work practice and compensation for employees, promote safe working conditions. So trade unions, they actually give representation to employees, and like for them to fight for their interests as individuals. So there is solving of problems and conflict. We are given here now, what does BEE acronym stand for? Uh, this is this isn't how we have envisaged broad-based empowerment. So, what is the meaning of BEE? BEE actually stands for Black Economic Empowerment. BEE deals Black Economic Empowerment. Black Economic Empowerment is what we mean by BEE. I'm sure I remember that is one of the latest uh, uh, scorecard when it comes to companies ratings and uh, compliances. So, which government department is responsible for the implementation of uh, BEE Act? It is actually forced, and it is enforced by the Department of Trade and Industry, Department of Trade, Industry and Competition. Department of Trade, Department of Trade, Industry, and Competition. Which is, sometimes I'm saying you should understand that this is a department that we are saying DTIC, Department of Trade, Industry and Competition. It is responsible for the enforcement of BEE. Briefly describe the term capital. Capital is actually money that is used to start a business. We can just say money needed to start up a business. We define that as what? As capital. Money that is needed to start up a business, we call that capital. What will happen to the unemployment rate if the government focuses on developing the skills of South African citizens? Obviously, the unemployment rate it will decrease. What we are saying is that what will happen to unemployment rate. So actually, the unemployment rate it will decrease. What causes it to decrease here is that uh, it will decrease because many people who have necessary skills for them to be employed. If people have got the skills, they can be able to be employed because they have got the skills. So when the when government focuses on improving the skills of its people, unemployment rate it will decrease because people will get the skills for them to work. People will have the necessary skills for them to be hired, and then unemployment rate will decrease. And then briefly explain the successes of BEE Act in South Africa. Explain the success of BEE in South Africa. It actually increased black ownership. It increased the black ownership. One, increased black ownership of businesses. Black ownership of businesses increased. So we have got a significant increase in black ownership and control of businesses. Our black majority are able or also have got the access to start businesses and control them because of BEE. It also enabled skills development, promoted skills development. It also promoted skills development, which we need to understand that skills improved and trainings for Black people, enhancing their career prospects. So career prospects have improved because of skills development. Career prospects improved due to attainment attainment of skills. Black people got skills and become employed. We can talk about diversification. It also promoted diversification. BEE Act promoted diversification, increased diversity in the economy with more black-owned businesses in various sectors, which was not the case. Blacks also get to have a share of businesses in the economy, unlike how it was before. We can also talk about job creation. Job creation, job creation. So what happens here in terms of job creation is that creation of employment opportunities for Black people, especially management and also skilled positions. Black people could also get management and skilled positions for Blacks. It is also an opportunity that came in there, which we can also need to talk about in terms of all these types of advantages of BEE of BEE Act, improvement in Black ownership of businesses, promoted skills development, diversification in terms of Black people owning businesses also, and also job creation, management and skilled positions for Blacks. It came because of that. So I want you to I want us to appreciate and note that this is how it is. And thank you very much for your time. I hope that we are going to enjoy this. We are actually going to thank you very much for your time, class. This is what we have for today. This is what we have for today. And I hope that you are going to enjoy and also get the best in your upcoming exams. It has been so nice to have this long discussion with you. Just bear it with us. It is just because you know, Musa, that revision can always take long because we have to explain concepts. We have to relate to other other points and areas of interest with regards to what the question is asking. So anyway, thank you very much and all the best. Keep on following, sharing, and liking our videos. Turn on your notification button. Don't forget to subscribe as well.